Welcome to another weekly market insight where we sift through the noise to get to the signals so you can have actionable advice and can make informed decisions. Joining me this week is Chris. We hope to actually make this a quick call after 50 minutes of really good information last week. So Chris, why don't we just jump right into it and look at just where we are on price points, on the technicals for the S&P 500. It looks like we're kind of bottoming off a pretty sharp sell-off. Still below the 50-day and 200-day moving average, so I wouldn't say this is bullish. A lot of times you want to see that 50-day move over the 200. You think the lows have been brought in yet?
Well, I actually like to look at it with a candlestick, which I pulled up on, I threw in here. So I think this is a pretty good way to look at what happened last week. So we haven't pulled the candlestick chart in a while. So the way they work is those green bars, that means you opened at the low part of the body and closed at the high part. And red is the exact opposite. You open at the top and close at the bottom of the body. And then you have those wicks.
Right.
So those show the extreme movement throughout the day. So if we go back to May 20th, we really see the body's pretty small, but there was a big intraday sell-off all the way down to the low, which is 38.10, which I think you marked as a Fibonacci retracement.
Yes.
And then we see some recovery, and then we get to towards the end of the week, we have that little May 24th, which looks like a cross. So you're opening and closing at the same price, but again, there were large intraday declines. But the bulls got control towards the end of the day and rallied off those lows. And then we really get to the end of the week rally. And that is, starting on May 25th, that was the Fed minutes. So their report from last month gets released. What did they talk about? Market perceived it as bullish. That gets a 2-day rally. And then May 27th, another really strong day. You see we're closing at the highs. And that was from the PCE inflation report, which we'll cover at the end. So pretty strong. I guess the only negative is it really happened on low volume. So those are the bottom bars. You really want to see high volume to support these moves. But we snapped a 7-week losing streak on the S&P, so pretty significant comeback. And we're up 6.5% last week.
And if we were to just draw a trend line from the highs, from the all-time high to the relief rally highs, that's broken a trend. So we've probably seen the bottom for this cycle. I think a lot of it is going to depend upon the Fed, which we'll talk about as well. Tell us about the buybacks,
I just
though.
wanted to say, we talked about who could be buying. You do get some end-of-the-month rebalancing when equity performance was as poor as it was. You also have the turn-of-the-month effect, which is a long-standing anomaly of money coming in at the end of the month and start of the beginning month. But that's a little bit of noise. But we do have some longer-term trends, which on the left we're looking at buybacks, which are the highest they've ever been, $250 billion in quarterly buybacks. And a lot of people think that's going to continue at that same quarterly pace. We'll see, but at least right now that's supportive. That's a few $billion a day in purchases for at least another month before we start to see blackout periods with earnings again. And then on the right panel, we're looking at insiders, corporate insiders, so executives, and they're net sellers of stocks in the long run, right? They have a lot of stock they need to reduce. And that's that bottom panel. So those red bars they're selling, green is buying. And when the market pulls back, which is the blue line, they stop selling and they start buying a little bit and they actually become net buyers. That's that red line, which gets back to, I think it's 1.04. So they're net buyers right now. So just a couple supportive trends we're seeing from companies buying back their stock, and then insiders also saying maybe they have a longer-term view of also buying their stock.
So those that have a better view of the inside of the company are finding these values attractive. Now, they're not investment managers,
right.
But they do know their company well. In addition, with the buybacks, we're still at pretty low interest rates. And if you're looking at what you're paying for equity on return versus what you're paying for interest, I think there's a lot of reasons on why there's still a case to own equity in these low rate environments, which the low rate environment gets us to the Fed, right? The Fed has just started to begin to tighten. We're only, 75 basis points total?
Yeah. I don't know, we don't often say it, so the range is 75 to 1. That's accommodative, right? We're below the inflation rate significantly, so it's really not going to do anything to fight inflation right now.
And as of yesterday, the Fed Chair Powell went and had a sit-down with the president. Now, I will say that it was far less political than previous ones. I remember President Trump basically saying Powell was crazy, he needed to be lowering interest rates. we didn't get much from the current administration on what the Fed would do. If anything, they kept saying, no, it's completely independent, completely independent. Of course, the cynic in me says, okay, that means that it's not independent at all. But the Democrats are really concerned about the upcoming election. They're assumed to lose control of the House, possibly the Senate. Now, with the Senate, there are more Republicans up for re-election than Democrats. It's really going to change on the next 2-year election whenever it's all of a sudden more Democrats are up. So they probably won't lose too much in the Senate, but I would say probability-wise, it's that the Republicans are going to gain seats. And then the Fed and the current administration's really getting that analogy of painting themselves in the corner. They got inflation that's causing them a lot of trouble in polls. But if they were to continue to tighten, just getting going, a recession's also not going to help them. So I'm sure it would have been interesting if we could be there and listen to it. By the way, Yellen had joined, who's now the Secretary of Treasury, but the previous Fed chair. So I'm sure there was a lot of discussion on monetary policy and the trade-offs between what's going to help the Democrats better, dealing with the inflation or dealing with a recession. Now, I would also say that a lot of people are blaming the inflation on Biden. He certainly hasn't helped. But I think the Republicans actually were done a big favor to not win the presidency in the previous election, because a lot of this came from the Republican spending also. So pox on both of those houses, as I usually say. But I'm concerned whenever I look at the money supply. It's really hard to get data. There's a lot of oddities that are happening within the data, but we can definitely see that slowing down in the money supply growth, and I think that's been the big reason for the market correction at this point. And that's what I'm going to be looking at to really say, is this a rally that we need to fade, or is this a rally that's going to be sustained? I think we're going to be in a trading range for a little while, but let's see what the Fed does. And here's another really interesting thing, because we're talking about quantitative tightening. We're talking about rolling off the balance sheet. And that's that blue line there. We can see 2018 to 2020-ish, early 2020, when Powell did reverse course based off of Trump's tweets. The market had a lot of volatility as the money supply was slowing and decreasing. And we can just see that from 2018 all the way to 2020, the ups and downs of the market, and eventually a crash. A lot of it is COVID, and then the big spike up. Now we're seeing the money supply begin to slow at the top, and we're seeing surprise volatility in the market. So this is something we're
today's day one of, they're going to be rolling off their bonds. They're
right.
No longer, so the last few months they've just been reinvesting to maintain. That's why you see that balance sheet staying flat. They're no longer buyers, but now they're going to be reducing the money supply when bonds and mortgage-backed securities pay their principal payments.
Right. And then that gets us to, they're just trying to stop this inflation. So on the left-hand side, we can see inflation spiking to, really, it hasn't been this high in 40 years. And then we've been working with an economist out of Florida, Dr. Newman, and he had put together a basic model of just looking at trends and trying to understand. And it does look like expectations for inflation is going to slow. Now, he has a little bit different take, which is the energy continuing to keep the price up. But I think this is consensus, that most people think that inflation is beginning to slow, and probably was part of that conversation between the president and the Fed chair yesterday. Want to talk a little bit about inflation?
So week over week, not a whole lot of data. Like I said, we had the Fed minutes, which were hawkish. If you read those, and we did, fully hawkish, right? They're talking about they're continuing their plan. They see that the market's pricing in all these increases, and they plan to go through with that. That's them saying, oh, the market's blessed this. Let's keep going through our plan. So there was nothing really in there that says we're going to reverse course at this time. But that's what the market expected to see. So a lot of times, you get some fear that maybe there would be something scary in there that hasn't been said, and that didn't happen, right? Mm-hmm. So that helps put in that bottom on Wednesday and continue the rally up through Friday, which is when we got this report, which is the personal consumption expenditures, the price index that the Fed follows most closely, more close than the CPI. And we said last month, when we're looking at the price index of PCE core, so you exclude food and energy, 0.3, about 3.5% annualized, that's really the sweet spot of what the Fed's looking for. And we got another month of that, 0.3. Market interprets that as bullish, that inflation is not continuing to rise at these really high paces, and that the Fed will be able to slow down in the future, or that the fight is working. and we got that sweet spot. So that's what we're looking for. 0.2, 0.3, 0.1 would be great. That would be really, really bullish, but I don't think there's any any reason to expect that coming unless you had significant supply chain resolution.
And we may have some supply chain resolution as China opens back up, but then that also causes inflationary problems that I don't think really gets talked about enough. Is yes, we're going to have supply chain, but now you also have one of the largest economies coming back online, and what is that going to do to the price of oil? Well, we're making new highs in oil. It has not been pulling back. So it'll be interesting to see what happens. And a lot of people continue to point to the consumer, and that's most of the U.S. economy is consumption. So they say, well, the consumer is going to keep us there. And we were looking at a chart, and it's an interesting chart, where we look at just consumer loans, credit cards, other revolving loans being used by the population is that red line. And we can see that it moves all the way up at a pretty quick clip from 2014 all the way to 2020. As interest rates continue to move down, it makes it easier to service the debt, so you can take on more debt. And then we look at the blue line, which is just this personal savings rate. And for quite some time, it's been very stable at about 7%. And we have this big spike. Well, what was that? COVID lockdowns. People can't spend their money on things that they were before. Plus, there was an enormous amount of stimulus that was provided. So the savings rate goes stratospheric. At the same time, that consumer debt plummets. Well, what were people doing? They were paying off debt as well. So then they continue to draw down on the savings as the fiscal stimulus, or I guess they're getting less income from the government, so that begins to take effect. And then they start to roll that back onto consumer debt. And we're now well below 5%. We're in the 4%. We haven't been this low since 2008. And what this tells me is the consumer is not in great shape the way that a lot of people are advocating. They've basically run their credit card statements back up, and to the point that the inflation is starting to inhibit their ability to save because so many other things are coming before those things. Yeah. So how long could it last? I'm not sure, but it doesn't look like this, or at least this doesn't make a great argument that the consumer is really solid and is going to be able to continue to.
That's probably one reason, a lot of people are out there saying consumers really strong, and we're saying, oh, they're okay.
Yes.
That's really where we drift away from the consensus, right? They're spending all this money on credit, which is short-term bullish as long as they can find credit, and credit's widely available, which the Fed actually said in the minutes that it is widely available, and that's something they're looking at for continuing this pace. But with that saving rate this low, it's just not a good long-term trend.
Right. You can't continue that for long-term. Maybe your balance sheet has really moved up, but I think we're all participating in the same market. We know that bonds and equities, like there hasn't been a place really to hide, so we know everyone's balance sheet has been impacted by this sell-off. And you have anything else to add? Well, we really appreciate you tuning in. Go ahead and hit that subscribe button if you haven't done so. Feel free to share it, and like it if you just enjoyed the quicker time on the Market Insight call. And we look forward. No, we won't be on next week, right?
Taking a week off.
We're taking a week off, so it'll be 2 weeks, and we will see you again. Thanks, and have a good day. Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.